It's a core human primal instinct to provide for and protect its children. Education has long been accepted as a key development process for our children, and the cost for parents is significant and sometimes seemingly unaffordable. Let's talk about saving for children's higher education. Welcome to another episode of Money Matters. There's no other feeling than seeing the birth of your own child. For many, it's a life-changing experience that rewires the brain. Maternal and paternal instincts kick in, and that little delicate flower becomes the center of your world. Becoming a parent is not only a huge responsibility, it's also a huge financial undertaking. According to the Hong Kong Bohemia Foundation Research Center, the cost of raising a child from birth to college graduation in Hong Kong averages about 5.5 million Hong Kong dollars for a middle-class family. Note that this was done back in 2014. The number one cost was clothing and food at 1.36 million, whilst education came a close second at 1.35 million. These figures are, of course, averages. Many parents would endeavour to provide the best for their child. Music lessons, private tutoring, summer camps, all add up to be a heavy burden on income. Lest we forget, international schools, boarding schools, and the best universities in the world all put a strain on the wallet. Luck favours the prepared. Financial planning is a generic term that involves the structuring of finances, accumulation and preservation of income and wealth to accommodate future planned events. Building a fund for children's education is a common topic and a natural part of a parent's life journey. However, because these days couples tend to start a family later on in life as they focus on their careers or whatever the reason may be, my experience is that people will reach financial maturity later on in life, and this is never a good thing. Think about it. In the past, our parents and their parents would have children at a much younger age than the parents of today. And the need to provide for a helpless little child of your own blood, what greater motivation is there than that? To take control of your finances, to think about the future, to save and invest, to ensure the safety of your child through the financial security of the family. Carpe diem, and time waits for no one. You want to get started, to form the right habits, and to put some money away for a rainy day. Firstly, you have to build up sufficient cash reserves, typically in the bank. Why? To provide for financial emergencies. No, not for that, whatever you've always wanted, for real emergencies. And if you cannot control yourself, use one of those accounts which you cannot access for 30 days. And what amount should you keep as a reserve? It depends. But I can suggest anywhere between 6 and 12 months living expenses. Once you've done this, get invested. Most will consider a monthly contribution to an investment account. They simply save a portion of their monthly salary. There is no rule of thumb as to how much you should save. Everyone's circumstances are so different, it doesn't make sense to give a guideline. Find what you're comfortable with and build up from there. Don't be too stingy or you won't make much difference. Just do some simple maths. Take the amount you were thinking of investing, multiply that by 12 months, and again by a number of years, and that's the total contribution into your account. If it looks pathetic, then quite simply, your monthly contribution is pathetic. If you're struggling to find the funds to save, then you'll just have to get honest and trim the fat from your expenses. It's amazing what you can trim if you really get honest with yourself. I will add that pay raises are a great time to save. This is money that you've never had before, and thus you can save it. Yes, of course, the cost of living naturally goes up too, but again, it's about controlling those expenses and saving as much as possible. Next, how do you invest? Well, the way I describe it is like setting up your GPS navigation. First, you have to set a destination. In this case, it's a pretty easy one as we have a fairly clear objective at hand. If it takes 18 years before your child will go to university, then we have an investment time horizon of 18 years. It is difficult to judge what level of fees and other costs will be accounted for in 18 years' time. But we can do some research for what it would cost to send a child to university today and inflate that by a fixed amount, 18 times compounding to take into account some inflation. So let's say you'll need $400,000 per year over 4 years. That's 1.6 million in total. Inflate that by 3% per annum to the power of 18, and that's approximately 2.72 million. This is the target to hit in 18 years' time. Yes, not all of it is needed in year 1 of university, but this calculation will do for now. Now, if we make some conservative assumptions that your investment will grow at 5% per annum, we can work out how much you will need to save per month to hit that target. Using a compound interest calculator, it works out that you will need to save $7,900 per month to achieve this target. Now, bear in mind that this is purely for university and for one child. Don't go dipping into this account for anything else. You'll need to make other provisions for other financial objectives, such as retirement. Over such a long time horizon, it is perfectly reasonable to expect a considerably higher rate of return. But for planning purposes, we can use a more conservative figure. Why can we expect greater returns over longer time horizons? This is because we can invest in assets that offer potentially greater long-term returns, but as a consequence, must suffer greater short-term fluctuations. But with time on our side, we can do this. What I'm referring to is utilizing equities as opposed to bonds, which have shown as an asset class to outperform bonds in the long run. Assuming, and it's a fair assumption, that you'll not touch this investment account for the next 18 years, who cares about the natural ebb and flow along the way? Roads are not a straight line from A to B, neither are market returns. So it's something you'll just have to expect as a stock market investor. If you do not and cannot accept the short-term fluctuations along the way, then don't play. Just don't even consider it. And do it the hard way by just saving in the bank. Just know that you'll need to save an additional $4,700 per month to hit that aforementioned target. If you can accept short-term fluctuations and are ready to invest, then you'll need to build a portfolio. But what do you buy? We'll focus on equities, which simply means you're buying shares of companies from across the globe. It is generally accepted that buying the shares of large companies is safer than buying shares in smaller companies. Why? In short, large companies can better weather bad times. When the economy is shrinking, people aren't spending, and losses are being made. Whereas in the same environment, a smaller company may be backed into a corner and go into liquidation. These large companies are typically called large cap or mega cap and includes all the big brands that we've heard of and use on a daily basis. Here we have Apple, AMD and McDonald's over the past 18 years. And it looks good. Any investor would be fairly pleased with the way the graph looks. But if we look at these 3 stocks over the past 5 days, and bear in mind that the financial news we receive day in, day out is always focused on the day-to-day, the short term, and thus, this is what we see as investors. Then we see a much more scarier graph. These natural market fluctuations will give the average investor heart palpitations, will humiliate those who don't take a long-term perspective, and ride out the ebb and flow of the markets. Next, you should build in diversification into your portfolio. I'm sure you've already heard of this. It's a common investment strategy, but why? Okay, this part you know already. If you only hold one asset, the value of your investment portfolio will be at the mercy of whatever that asset is valued at. However, if you own a variety of assets, and assuming that some of them are uncorrelated or better still negatively correlated, the value of your investment portfolio will suffer lower levels of short-term market volatility. Sure, your portfolio will not be immune to the global financial crisis and global pandemics, as pretty much all assets are crashing. But I'll say again, volatility is part and parcel of market investing. However, with a more diversified portfolio, you'll have more restful nights. Additionally, and more importantly, you'll probably be less likely to attempt to time in and out of the market, employing instead a buy and hold strategy. Watch my video on 5 reasons why timing the market doesn't work. So, you can buy mutual funds or buy index tracking ETFs. There's a whole other video, but know that these collective investments are an easy way to build diversification into your portfolio. Choose regions from across the world and ensure you hold a bit of everything. With a globally diversified portfolio of stocks, you can rely on global markets to eventually and always continue to rise. You can watch my video on why markets eventually and always continue to rise. If you cannot outsmart the markets, then simply ride the markets. There's no harm in doing that whatsoever at all. The S&P 500 index delivered annualized returns of 9.63% from 1929 to 2009, not including dividend payments. Find me an investor who will complain about that. Finally, at least for this video, keep things simple and ensure transparency. Buy investment assets, not investment products. If a product has a ton of features you don't understand, stay away. If a product shows that it takes years and years to break even, stay away. If a product has a USP with no apparent downside, stay away. And if a sales pitch sounds too good to be true, stay away. It doesn't matter about the brand or the free pen, buy appreciating assets. In the end, you'll need an account or investment wrapper to hold a bunch of stocks, bonds, whatever. And you'll make returns from capital gains, dividends, and interest payments, depending on what you're holding. It's quite simple, really. If you're using a professional to build and manage your portfolio, know what you're paying for. If you're executing the trades yourself and managing the portfolio yourself, be particularly cost conscious. And remain steadfast during market downturns. Avoid trends and hot stocks. Be careful of financial news and don't just take information at face value. Micromanage your income and expenditure. Save whenever and wherever you can. Every cent counts. Because this is a wonder that has entered your life, is the center of your universe, and everything you do for them. So take action and get the ball rolling. Time waits for no one. I wish you the very best of luck. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in the future videos. If you like this video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.